Money behaves very differently depending on who is controlling it. For most people, money is something to earn, spend, and occasionally save. It is tied to immediate needs, lifestyle choices, and short-term goals. But for the wealthy, money is treated as a long-term tool. A system designed not just to store value, but to generate more value over time. This fundamental difference explains a powerful and often misunderstood truth. The wealthy rarely sell their assets. Selling an asset might seem like the obvious way to make money. You buy something at a low price, it increases in value, and you sell it at a profit. On the surface, this looks like success. However, what most people don't realize is that selling an asset also ends its potential. When you sell, you stop benefiting from future growth, compounding returns, and long-term appreciation. The wealthy understand that wealth is not created through one-time gains, it is built through long-term ownership. At the core of this philosophy is a simple but powerful idea. The wealthy think like owners, not traders. A trader is constantly looking for the next opportunity. They buy and sell frequently, trying to capture short-term price movements. An owner, on the other hand, focuses on what the asset will become over time. Owners ask questions like, how will this business grow? How will this property appreciate? How much income will this investment generate over the next decade? This shift in perspective changes everything, especially when it comes to the decision of whether or not to sell. One of the biggest reasons the wealthy avoid selling assets is the power of compounding. Compounding occurs when the returns on an investment begin to generate their own returns. Over time, this creates exponential growth. However, compounding only works if the asset remains invested. The moment an asset is sold, the compounding effect stops. By holding on to assets for longer periods, the wealthy allow their investments to grow significantly over time. Even small annual returns can become substantial when compounded over decades. For example, consider an asset that grows at a modest rate each year. Over a short period, the growth may seem insignificant. But over 20, 30, or even 40 years, that growth becomes substantial due to compounding. The wealthy understand that time is one of the most powerful tools in investing. Instead of trying to time the market, they focus on staying invested for as long as possible. Another important factor is taxes. When an asset is sold, capital gains taxes are often applied to the profits. These taxes can take a significant portion of the gains, reducing the overall return. Wealthy individuals are highly aware of this and structure their investments in ways that minimize tax liabilities. By holding assets longer, they can often benefit from lower tax rates or defer taxes entirely. In many cases, avoiding a sale is simply a more tax-efficient decision. Taxes are not just a minor detail, they are a major factor in wealth preservation. Every time an asset is sold, a portion of the wealth created is transferred to the government in the form of taxes. Over time, repeated selling can significantly reduce long-term wealth accumulation. The wealthy understand that minimizing unnecessary tax events is one of the most effective ways to preserve and grow wealth. In addition to tax considerations, the wealthy also focus on generating income from their assets, rather than selling them. Many assets are capable of producing ongoing cash flow. For example, dividend-paying stocks provide regular income, rental properties generate monthly rent, and businesses can produce consistent profits. By holding on to these income-generating assets, the wealthy create streams of passive income that support their lifestyle without requiring them to sell their holdings. This approach creates financial stability and independence. Instead of relying on selling assets to generate cash, wealthy individuals can live off the income their investments produce. This allows them to maintain ownership of their assets while still enjoying financial freedom. In many cases, the income generated from these assets exceeds what could be earned by selling and reinvesting elsewhere. Psychology also plays a significant role in the decision to hold rather than sell. Most people are influenced by emotions such as fear and uncertainty. When markets decline or economic conditions become unstable, the instinct to sell and protect money becomes strong. However, selling during these periods often leads to losses, as assets are sold at lower prices. Wealthy individuals are trained to resist these emotional impulses. They understand that market fluctuations are normal, and that long-term trends are more important than short-term volatility. This ability to remain calm during uncertainty is a defining characteristic of wealthy investors. Instead of reacting emotionally, they rely on data, strategy, and long-term planning. They understand that financial markets move in cycles, and that downturns are often followed by periods of growth. By holding their assets during volatile periods, they position themselves to benefit when the market recovers. Another reason the wealthy rarely sell is that they have access to alternative ways of accessing money. Instead of selling assets to generate cash, they can borrow against their holdings. This strategy allows them to maintain ownership while still accessing liquidity. For example, an individual with a large stock portfolio may use those investments as collateral to secure a loan. Similarly, real estate can be used to obtain financing without selling the property. This approach provides flexibility without sacrificing long-term growth. The asset continues to appreciate and generate returns, while the borrowed funds can be used for other investments or expenses. This creates a powerful financial advantage, allowing the wealthy to leverage their assets without interrupting their growth potential. Timing the market is another challenge that most investors face. Many people attempt to buy low and sell high, but consistently predicting market movements is extremely difficult, even for professionals. Wealthy investors understand this and instead focus on time in the market rather than timing the market. They recognize that long-term investing is more reliable than short-term speculation. By holding assets over long periods, they reduce the risk associated with trying to time market fluctuations. While short-term movements may be unpredictable, long-term trends tend to be more stable and upward over time. This approach allows them to benefit from overall market growth without the stress and uncertainty of frequent trading. Wealth preservation is another key reason the wealthy avoid selling. For many wealthy individuals, the goal is not just to accumulate wealth, but to preserve it for future generations. This often involves creating structures such as trusts and estate plans that allow assets to be passed down without being liquidated. Selling assets can disrupt this process and reduce the amount of wealth that is transferred to future generations. By holding on to assets, the wealthy ensure that their wealth continues to grow and benefit their families over time. This long-term perspective is a defining characteristic of generational wealth. It shifts the focus from short-term gains to long-term sustainability. Control is another important factor. Ownership of assets provides control over financial outcomes. When you own an asset, you can decide how it is used, managed, and grown. Selling that asset means giving up control over its future. The wealthy value this control and are often reluctant to give it up unless absolutely necessary. In addition, holding assets allows wealthy individuals to maintain influence in businesses and markets. This influence can be used to guide decisions, shape strategies, and participate in future growth. Selling removes this influence and limits future opportunities. Market volatility also plays a role in the decision to hold. Markets are naturally unpredictable in the short term. Prices can rise and fall based on news, economic data, and investor sentiment. For many investors, this volatility creates anxiety and leads to reactive decision-making. However, the wealthy view volatility as a normal part of investing. They understand that temporary fluctuations do not determine long-term success. In fact, volatility often creates opportunities. When markets decline, asset prices fall, making it possible to acquire more assets at lower prices. Wealthy investors often take advantage of these opportunities rather than selling. They use downturns as a chance to strengthen their positions and increase their long-term gains. Discipline is another key factor. Wealthy investors follow strict rules and strategies that guide their decisions. These rules help them avoid emotional reactions and stay focused on long-term goals. Discipline ensures that decisions are made based on logic and strategy, rather than fear or excitement. This disciplined approach is what allows wealthy individuals to remain consistent over time. While others may react to short-term events, the wealthy stay focused on their long-term vision. This consistency is one of the most important factors in building and maintaining wealth. Ultimately, the reason wealthy individuals rarely sell their assets comes down to a combination of strategy, psychology, and long-term thinking. They understand that selling interrupts compounding, triggers taxes, reduces control, and limits future growth. Instead, they focus on holding assets, generating income, leveraging their investments, and building wealth over time. Wealth is not created through constant buying and selling. It is created through patience, discipline, and long-term ownership. The wealthy do not chase quick profits. They build systems that allow their money to grow continuously over time. In the end, the difference is not just in how the wealthy invest, it is in how they think. They see assets not as things to be sold, but as engines of wealth. And by holding on to those engines, they allow time, growth, and compounding to do the work for them. This is the real secret. The wealthy don't sell, because selling stops the process that creates wealth. The story doesn't end here. Subscribe now, and stay ahead of what's coming next.